What happens when a country goes bankrupt? It begins not with a bang, but with a quiet, unnerving silence. It's the silence of an ATM screen that simply reads, "Transaction cannot be processed." It's the silence in a manager's voice as they announce that paychecks, for the first time in company history, will be indefinitely delayed. It's the silence of your banking app, frozen on a loading screen, refusing to reveal the numbers that you thought defined your security, your future, your life's work. We are taught to think of a country's economy as a vast, impenetrable fortress, an edifice of such scale and complexity that it could never truly fall. We see the marble columns of stock exchanges, the steel towers of finance, and we assume permanence. We trust the numbers on the screen. But history whispers a different, far more unsettling truth. Empires that spanned continents have vanished. Currencies once accepted as solid as gold have become worthless paper. The fortress, it turns out, is a house of cards, built not on concrete and steel, but on a single, fragile foundation: trust. When a country goes bankrupt, a process more accurately called a sovereign default, it is not a corporate filing or a clean slate. It is the moment that trust shatters. It is an economic earthquake where the ground itself, the very concept of money and obligation, gives way. For the citizens living through it, it is not an abstract headline. It is a sudden and brutal education in what wealth truly is and what it is not. This isn't a story about a distant past. It has happened again and again in our modern world. And the lessons it leaves in its wake are a blueprint for a future that may be closer than we dare to imagine. The Corralito, a modern cage in Argentina. To understand what a national default feels like, we must travel to Argentina at the dawn of the 21st century. In the 1990s, Argentina was the poster child for emerging market success. It had pegged its currency, the peso, one-to-one with the US dollar, a move that tamed hyperinflation and created an intoxicating sense of stability. Foreign investment poured in. Buenos Aires felt more like Madrid or Paris than a Latin American capital. The middle class bought imported cars, took vacations in Miami, and saved confidently, diligently in US dollar bank accounts. They trusted the peg. They trusted the banks. They trusted the system. But beneath the surface, the fortress was rotting. To maintain the dollar peg, the government had to borrow staggering amounts of foreign currency. Its spending was lavish, its debts unsustainable. By 2001, the world's investors began to see the cracks. The flow of foreign money slowed, then stopped. The government, starved of cash, found itself in a death spiral. The Argentine people, who had lived through cycles of inflation and chaos before, sensed danger. They began to do the one thing the system could not withstand. They tried to claim their money. A quiet, then frantic bank run began as citizens lined up to withdraw their US dollars, seeking the safety of cash they could hold in their hands or wire abroad. The fractional reserve banking system, the same system that underpins the entire global economy, is a machine that runs on confidence. It functions only because we all agree not to ask for our money back at the same time. In December 2001, in Argentina, that agreement was broken. Faced with collapsing banks, the government did what desperate governments always do. It chose to save the system by sacrificing its citizens. On December 1st, 2001, Minister of Economy Domingo Cavallo announced the Corralito, or the Little Corral. It was a deceptively gentle name for a brutal act. Overnight, all US dollar-denominated bank accounts were frozen. Citizens were forbidden from withdrawing their own savings, capped at a pitiful 250 pesos, then, theoretically, $250 per week. The reaction was instantaneous and volcanic. The illusion of middle-class prosperity vanished. This wasn't a stock market crash affecting the wealthy. This was a direct seizure of the savings of teachers, doctors, shop owners, and retirees. The very money they had set aside for a child's education, a down payment on a home, or a comfortable old age was now trapped behind a digital wall, inaccessible. The streets of Buenos Aires erupted. The sound of the city became the deafening clang of the cacerolazo. Protests where millions of ordinary people banged pots and pans, a primal scream of betrayal. They weren't just angry about the money, they were enraged by the broken promise. The social contract, the implicit understanding that the state will protect its citizens' property, had been torn to shreds. What followed was a full-scale societal collapse. The economy froze. Without access to their savings, businesses couldn't pay suppliers or employees. Unemployment soared past 20%. The poverty rate doubled. The political system imploded. In the chaotic span of just 2 weeks, Argentina cycled through 5 different presidents. For ordinary people, life became a desperate scramble for survival. The formal economy was replaced by a shadow world. Barter clubs, or truques, sprang up across the country, where people traded used clothes for food, a haircut for vegetables. The US dollar, which could no longer be withdrawn, became a mythical currency traded on the black market at a huge premium. The government eventually defaulted on its $93 billion debt and forcibly converted all dollar savings into devalued pesos, wiping out a generation of wealth in a single keystroke. The lesson from the Corralito is the first and most terrifying lesson of a sovereign default. Your money in the bank is not your money. It is an unsecured loan to an institution that, when push comes to shove, will be protected by a government that sees you not as a citizen to be served, but as a creditor to be ignored. The austerity straitjacket, when a developed nation loses control. If it's tempting to dismiss Argentina's crisis as a uniquely developing world problem, the story of Greece offers a chilling rebuttal. This wasn't a distant South American nation. This was the cradle of Western civilization, a member of the European Union, a country that had adopted the euro, one of the world's strongest currencies. Greece's entry into the Eurozone in 2001 was its own form of the Argentine peg, a promise of stability and access to cheap credit. And for a while, the promise held. Flush with low-interest loans from German and French banks, the Greek government went on a spending spree, funding generous pensions, a large public sector, and the 2004 Athens Olympics. The nation was living beyond its means, but as long as the cheap credit flowed, the party continued. The global financial crisis of 2008 was the moment the music stopped. As credit markets froze worldwide, investors suddenly looked at Greece's books and realized the truth. The country was functionally insolvent, its debts far beyond its ability to repay. Panic ensued. Bond yields skyrocketed. Greece was locked out of international borrowing markets. This is where the story diverges from Argentina's in a crucial way. Because Greece was part of the euro, it could not devalue its currency. It could not print its way out of debt. It was a sovereign nation trapped in a monetary straitjacket at the complete mercy of its creditors. Enter the Troika, the International Monetary Fund, the European Central Bank, and the European Commission. They agreed to a massive bailout package to prevent a messy Greek default that could have contagion effects across the Eurozone. But the bailout came with crushing conditions. The price of the rescue was austerity. Austerity is a clinical, sterile word for a deeply painful human reality. To receive the bailout funds, which, critically, went not to the Greek people, but primarily to recapitalize the foreign banks that had made the reckless loans in the first place, the Greek government was forced to inflict savage cuts on its own society. Pensions were slashed by as much as 40%. The salaries of public employees were cut, and tens of thousands were laid off. Taxes, especially on property and consumption, were hiked dramatically. Hospitals ran out of basic supplies. The social fabric, woven over decades, was systematically dismantled. The streets of Athens became a battleground of riots and protests, as a populace that once had European aspirations found itself in a state of economic despair. The official unemployment rate soared to over 27%. For youth, it was a staggering 60%. A lost generation emerged, highly educated, yet with no prospect of a job. Suicide rates spiked. The dream of European integration had become a nightmare of debt peonage. The Greek crisis reveals the second great lesson of a sovereign default. When you owe debt in a currency you do not control, you lose your sovereignty. The Greek government was no longer governing for its people. It was administering a debt repayment plan on behalf of foreign creditors. The tough medicine of austerity wasn't designed to heal the Greek economy, but to ensure the banks that had gambled on Greek debt were made whole. For the average citizen, it was a brutal transfer of wealth, where their pensions, their jobs, and their public services were sacrificed to pay for the mistakes of a global financial elite. The perfect storm. When the supply chains break in Sri Lanka. The most recent defaults offer a new, more modern lesson. They show how quickly collapse can come in our deeply interconnected global economy. Consider Sri Lanka in 2022. Sri Lanka's crisis was born from a perfect storm of disastrous policy and external shocks. In 2019, a newly elected government enacted massive, populist tax cuts, gutting state revenue. It then made a catastrophically misguided decision to ban all chemical fertilizers overnight, crippling its agricultural sector and turning the nation from a food exporter into a food importer. This internal mismanagement made the country incredibly vulnerable. When the COVID-19 pandemic hit, Sri Lanka's vital tourism industry, a key source of foreign currency, evaporated. As the country was still reeling, the war in Ukraine caused global food and fuel prices to skyrocket. For Sri Lanka, which had to import nearly everything and had massive foreign debts to service, this was a death blow. Its foreign currency reserves dwindled to almost nothing. In April 2022, the government announced it was suspending payments on its foreign debt. It was the country's first default since its independence. What happened next was not a digital freeze like the Corralito, but a physical grinding halt of modern life. Without dollars to pay for imports, the country ran out of fuel. For months, citizens waited in lines that snaked for miles, sometimes for days, just for a few gallons of gasoline. The country ran out of cooking gas. It ran out of medicine. The government imposed rolling power cuts, plunging the nation into darkness for up to 13 hours a day. Schools closed, surgeries were postponed. The economy didn't just contract, it ceased to function. Inflation hit hyper levels, with food prices rising over 90%. A kilogram of rice that cost 100 rupees before the crisis soared to 500. A family's life savings could barely buy groceries for a week. This time, the public rage was not aimed at faceless banks, but directly at the political dynasty they blamed for their ruin. In July 2022, hundreds of thousands of protesters, mobilized by social media and fueled by months of hardship, stormed the presidential palace in Colombo. The images were stunning. Ordinary citizens swimming in the president's pool, working out in his private gym, and cooking meals in his kitchen. The president fled the country. It was a raw, powerful demonstration of a people reclaiming their sovereignty from a failed ruling class. The Sri Lankan collapse teaches us the third critical lesson. In a globalized world, financial collapse and physical collapse are intertwined. The fragility of international supply chains means that a lack of foreign currency isn't just a financial problem. It is a direct threat to a nation's ability to provide food, fuel, and medicine. It demonstrates that even a seemingly stable, middle-income nation can be brought to its knees by a convergence of bad policy, geopolitical events, and the unforgiving mathematics of debt. The unspoken truth. Are we so different? Argentina, Greece, Sri Lanka. These stories feel distant, extreme. We watch them on the news and comfort ourselves with the thought that it could never happen here. We have the US dollar, the world's reserve currency. We have the Federal Reserve. We have deposit insurance. We have the fortress. But the same forces that brought these nations to ruin are at work across the developed world, only on a far grander scale. The United States national debt now exceeds $35 trillion and is accelerating at a pace of $1 trillion every 100 days. Japan's debt-to-GDP ratio is over 260%. Many European nations are in a similarly precarious position. For decades, these countries have papered over structural problems by borrowing from the future, enabled by central banks that can create money at will. Like the Roman emperors shaving silver from their coins, modern governments have diluted the value of their currencies through relentless printing and debt accumulation. We don't call it debasement. We call it quantitative easing and fiscal stimulus. But the principle is identical. The system works, as it always does, as long as trust remains. Trust that the debt will be honored. Trust that the currency will hold its value. Trust that the numbers on the screen are real. But what happens when that trust begins to falter? What happens when foreign creditors no longer wish to buy a nation's bonds, or at least not at such low interest rates? What happens when the citizenry awakens to the fact that inflation is not a temporary anomaly, but a deliberate policy of wealth confiscation? The government's toolkit in such a crisis is terrifyingly familiar. We saw it in Argentina with capital controls. We saw it in Cyprus in 2013, another EU member, where the government imposed a bail-in, literally seizing a portion of uninsured deposits to save its banks. We saw it in the United States in 1933, when Franklin D. Roosevelt declared a nationwide bank holiday and made private ownership of gold illegal, forcing citizens to turn in their gold for devalued paper dollars. These are not historical curiosities. They are the emergency levers of power, pulled when the state prioritizes its own survival over the property of its people. The ultimate lesson history teaches us about a country going bankrupt is this. It is a moment of violent, involuntary truth. It strips away the comforting fictions of modern finance and reveals the brutal reality underneath. It reveals that your pension, your 401k, and your bank savings are not tangible wealth. They are a series of promises, denominated in a currency whose value is guaranteed only by the full faith and credit of a government that is itself insolvent. When a country defaults, it is not just an economic event. It is a transfer of wealth. It is a transfer from those who trusted in paper promises to those who held real assets. It is a transfer from the unprepared to the prepared. It is a transfer from the passive saver to the active survivor. The fortress of the global financial system looks stronger than ever. The lights are on, the numbers are climbing, and the music is still playing. But the foundations are groaning under the weight of unprecedented debt. History does not repeat, but it certainly rhymes. and the tune it's playing now should feel uncomfortably familiar to anyone who has been listening. The final question is not if the trust will be tested, but on which silent morning you will wake up to find it already gone.